Welcome to ForexTV.com's New York Forex Market Buzz. It's Tuesday, February 5th. I'm Remy Hokie. In afternoon trade as of 1:15 p.m. Eastern Time, Euro-dollar is at 1.4642. Sterling dollar is trading at 1.9627, while dollar-yen is at 1.0689. In today's U.S. data releases, business activity in the non-manufacturing sector contracted in the latest month. The ISM's index plunged to 41.9% in January. That's down from the 54.4% in December and the biggest one-month decline in the history of the index. Meanwhile, the RBA raised its benchmark interest rate by 25 basis points to 7%, and that's the highest level it's been at in 11 years. Joining me this afternoon is Matt Kassel, Director of Proprietary Trading at ING. Good afternoon, Matt.
Good afternoon.
Thanks for joining us on this Tuesday afternoon. Well, Matt, given that the RBA hiked to 7%, this means that there's a rate gap of 4% between the U.S. and Australia. But the U.S. dollar has seen strength in today's session, most notably touching a high of 1.4623 against the euro. So what's supporting the U.S. currency today?
Well, there's a couple of forces at work. One would be the obvious, which is equity weakness, which forces risky trade to unwind. We've seen yen crosses sold off, maybe not dollar yen quite so much, but Aussie yen, euro yen, sterling yen, all these currency pairs have come off on the back of the equity weakness. But more importantly, I think on a bigger picture, what we're seeing is more confirmation that the U.S. economy is either in a recession or heading towards one. Most economists would agree that we are currently in a recession already, but the pure definition wouldn't be told until months thereafter. What that really does is the market's starting to awaken to the fact that the decoupling theory, which was prevalent about 6 months ago, is not going to come to fruition. The decoupling theory suggests that while the U.S. goes into recession, the global growth being as strong as it's been in the last 12 months is strong enough to shield some of the other G7 nations from some of the U.S. turmoil. This is proving not to be the case. We saw this with the very, very weak European retail sales, particularly out of Spain this morning, and we're starting to just see a little bit more momentum picked up on the downside in some of the European economies. There was a call for a rate cut by the ECB, by one of the labor unions out of Europe, and this is just adding to the inability for decoupling to really get momentum.
Well, let's shift our focus back to the U.S. The Fed funds rate is currently at 3%, and there are expectations for another 50 basis point cut in March. But the market is also looking ahead to Thursday's ECB and BOE announcements. So what are your levels going forward ahead of the meetings for the euro and sterling against the U.S. currency?
Well, we're still 2 days away from that, so I think that talking about levels going into the meeting is a little bit premature. But I do think that we've broken down kind of substantially in euro sterling. This has been a trade that people have had on for many months now. And while the data and the forward-looking would suggest that sterling would remain weaker than the euro sterling is being sold off on position unwind. So you can't discount not only what the fundamentals are in the market, but you always also have to consider what type of position liquidations are going through leading up to big data, big decisions like the ECB and the Bank of England. More importantly, I believe, than the Bank of England decision on Thursday is going to be the inflation report next week, which is really much more forward-looking and will allow forward traders to price in future rate cuts by the Bank of England.
Well, as you mentioned, equities here in the U.S. have taken another hit on the day, with the major indexes seeing a decline of over 1.5%. Dollar-yen remains under pressure, but the question is, what is the risk of the pair pulling back below 105 again?
The risk is certainly there. I think there's some semi-official interest trying to buy some dollar-yen around mid-106. It has thus far supported dollar-yen, and a lot of the yen crosses being sold off have been led by other currencies. So I really don't see there being much topside in dollar yen right now, given the current environment. The history of the ISM having a very strong correlation with U.S. Growth forecast. Therefore, the economists are going to start spinning that we're already in a recession wheel very strongly. And whenever the U.S. is in a recession, dollar yen does not trade very well. In the meantime, however, there is semi-official bids in dollar yen. There is good buying going on, and I think that in the next couple of days, we shouldn't look for too much downside in dollar yen. If we're going to see the yen crosses unwind, it's going to be led by currencies.
Okay, and before we wrap it up, I want to touch on a subject that you mentioned. The U.S. is facing a softening job market and continued deterioration in housing, and you also mentioned the R word. So give us your take on how the U.S. economy will affect global growth. And while we're talking about growth, what's your outlook for the currency for our neighbor up north in Canada?
Sure. Well, there's really no way to get around the U.S.'s purchasing power. We purchase about 25% of all goods. If the U.S. consumer stops buying, which they already have stopped, you're looking at a significant slowdown in global growth. We've seen comments that come out of China in the last 2 or 3 days which suggest that they are not capable of decoupling, and they are the one country in the world that many strategists and forecasters believe had the greatest chance of decoupling. The more and more data that we start to see out of the U.S., it's not just not good. It's quite bad. As you noted before, this is one of the largest month-on-month declines in the history of the ISM index. These are really important indicators of what's going on in the U.S. economy right now, and it's slowing drastically. We are already probably in negative growth. We're already showing negative job growth. These things are going to have a toll on the U.S. economy, and it's going to bring down the rest of the world with it.
Okay,
as far as dollar Canada is concerned, today's confirmation of further weak U.S. data has hit oil quite a bit, has hit gold quite a bit. All the commodities are coming off a bit. It's one of the reasons why Aussie has not really rallied in light of the RBA rate hike, and it's one of the reasons why dollar Canada will probably continue to trade higher, probably up towards that 102, 103 region before settling back down.
Okay, Matt, as always, thank you very much for insight and analysis into the Forex marketplace.
Thank you.
This has been your Forex Market Buzz with Matt Kassel, Director of Proprietary Trading at ING. I'm Remy Hoki. Join us later this afternoon for PM Exchange right here on ForexTV.com.